Fed cuts off the table, market volatility uptick has got the market investors on edge. This week we're going to check out how we got here and where we might be headed. So whether it's conversations with friends, family, clients, the various headlines that are making their way into my email box on a morning basis, clearly nerves are beginning to fray. We came into this year after a surprising 2023. I think everyone after what was a tough year in 2022 didn't have high hopes, only to be surprised, particularly with the strength there at the end of the year of the market. And so we came into 2024 with a lot of optimism. Investor sentiment went almost pegged out to the high side. If you were to look at various indices, you had all sorts of raising of targets for the S&P by various banks around the world. And of course, the expectation that the Fed would be able to cut anywhere from 4 to 6 times. And then it was 3 times. And we're told inflation was going to slow down. And now here we sit today with various Fed speakers having come out, let alone various pundits saying, you know what, those rate cuts that we all hoped for in 2024 are off the table. And as a result, you're seeing a little bit of nerves in the market. If you're so interested, you can go back to our March 15th comment where we mentioned this as one of those possible paths to be ready for. Again, not a prediction. We're not in the prediction business. We're in the looking at all the different probabilities and possible paths business. And that was one that we thought was being really underlooked. So where are we at? Well, peak to trough, the S&P's dropped about 4%. Not all that much to be told, but I know it can feel like a lot to people. So that's where we've been. Point 2 is let's get some perspective around this to understand where it really fits and where maybe we should be thinking about it. Matt's gonna pop up a chart, probably seen many times here at 10 Capital over the years, showing just kind of intra-year volatility. So all those red dots you're seeing are kind of the intra-year peak drops within the market, the gray bars, the net return for the market in that calendar year. And 2 things should jump out. 1, lots of red dots, including some dots that really get down there on the page, and yet mostly positive gray bars. And so I think that's just always a healthy thing to keep in mind is most years, historically right around 75% of years, are positive within the S&P 500. Caveat, not that it's all about the S&P 500. But volatility is a very common thing. On top of that page, you'll see on average, not that we ever get exactly average, you have about a 14% drop in equity markets in any given year. And very few of those 4 to 5% dots, you see a lot of those become 10s, and very few of those 10s become 20s, and even fewer of those 20s become 40s. And so while it's very natural to, on the onset of a little bit of uptick in volatility, think, oh, we're on the verge of another catastrophe, statistically, historically, that's not the case. One thing is just to keep in mind that volatility, again, is the price we pay to be an investor. It's part of the journey, especially for those people who want to be in equity markets to hopefully get that growth over time. Point 2 of perspective is gains tolerance versus pain tolerance. 2 different things. So when assessing one's risk tolerance, keep in mind, we all have high gains tolerances. We'd all like to make a lot of money. We don't necessarily, as investors, all have the same risk tolerance, i.e. pain tolerance, to be able to achieve those returns or at least invest in those types of asset classes. You need to test yourself in some pretty counterintuitive ways. Of course, everyone wishes they could add risk and participate in the momentum of a great market. The time to ask yourself whether you should have a little bit more risk, a little bit more risk assets within your portfolio isn't during a bull market run. Everybody wants to take part of that. It's in a bear market run. Are you still willing to add that risk when markets are selling off, which is probably a more opportune time to do so, or not? Similarly, if you want to be a super conservative investor, how are you feeling when we're in the middle of a bull market? Are you still comfortable with that? Can you rationally tell yourself, even if you've got some different feelings, that, hey, this is what I signed up for. I know it might take me a little bit longer. I want the longer, smoother ride. Or are you beginning to feel the need to panic and again, make a mistake of legging into something that's too risky? Test those things. We're here. We've got literal tools, conversations, of course, a lot of experience to help you with those conversations. But again, this is a place that it's easy to make critical mistakes. Point number 3 is, again, picking that strategy that you can stick with. So other chart coming up here, this from our friends at AMG, and you can see 2 things. 1, the diversified investor on the left versus just the equity investor gets near the same return, about a 1% difference over decades, but with 33% volatility. So maybe you're the person that says, man, that seems right to me. That's a good risk-adjusted return. I like the smoother ride. Maybe you're the person who says, well, no, I want to go for the most that I can get. What they point out in that green box above, though, is theoretical returns are one thing. What you can practically experience is another. This emotional burden that we have as investors is big. It gets tested during market volatility. And what they argue, and we would concur, is your odds of being able to stick with a plan go up greatly with that reduced reduction, about 33% historically, if you look at that chart. And so keep that in mind. Am I going to be able to stick with this emotionally? And then also financially, be diversified enough that if we get into a scary market, a recession, maybe we get laid off or have an emergency need, do we have some parts of our portfolio that we can get money from without having to sell something that's been beat up? Both those components are going to take those theoretical returns and have big impacts on what one might practically experience. Lastly, the path forward. What the path forward isn't is predictions. We talk about all the time. Happy to tell people what we think might be happening. Again, not to predict, but to prepare. Knowing different paths that might come out. What are the perceived probabilities, more or less likely, of those things, to avoid as many surprises as we can, and thus avoid, hopefully, the emotional reactions to those surprises that might lead to a bad decision. Second is positioning in the path forward. That's where we need to put the time. And the first thing I'd say is it's not about a given asset class. You don't have to invest in stocks. But what you need to take into account is, number 1, inflation. Can you beat it? Can you maintain your purchasing power? 2, what are your goals? What are you trying to accomplish? And what types of return sets might you need to help assist you in getting to those goals? Which then leads to the third point, which is, okay, there's a price to be paid beyond just the savings factor, which is, do you want to take a more conservative or a diversified path that might have a little bit lower rate of return and thus pay in terms of time and patience? Or do you want to pay in terms of volatility? I think, again, innately, subconsciously, we don't want to pay anything. We want a smooth ride with no cost. Again, as it talks about in the psychology of money, don't think about this as a fee or a fine or a penalty. Think of it as the price to admission to the amusement park, as this example. You want to take the ride, you want to have the ultimate experience, but there's going to be, again, some dips along in that journey. With that, this is what we're here for all the time, is to help with the mental side, the planning side, in addition to the portfolio. Thank you for so many of you who we get the chance to work with. And for any of the rest of you, of course, reach out anytime. Thanks.